Hey Trading Nation, this is Todd Gordon of TradingAnalysis.com. In the Trading Cave, we're going to be taking a look at the gold market today. The Fed increased interest rates by 25 basis points, but left a lot of interest rate hawks really pretty shell-shocked. We saw the Fed indicate they might only have 2 interest rate increases this year when markets were looking for 3. So what we saw was the U.S. dollar sold off as foreign currencies rallied. We saw the bond market move up, pushing bond yields down, and the gold market is up pretty significantly here today as shorts are covering on the back of a rather dovish Fed. So I want to focus in on the gold market. Let's go ahead and set up the trade. So here we are looking at the GLD. This is the ETF that tracks the gold futures. And you can see the market's had a pretty nice move up. Starting actually at the end of 2016, we topped out there in February and we've set back. Now, the depth of this correction is actually interesting. If we take a fib retracement, you're going to see that we actually did a exact 50% price retracement. So all that means is the total distance traveled in this run from $108 to $120, we pulled back right prior to the Fed to the 50% price retracement, and that's what gave the market the boost higher, is this 50% half-back level. So it looks like the market should be able to continue higher, and the trade I'd like to set up really pretty simple and basic, guys. I'd like to be able to just retest this old 120 level. If it wants to break out through there, that's fine with me, but let's just get up to the point of decision from 117 up to 120. That's how we're going to structure our option trade, really just that simple. So let's set up the GLD trade. Again, we're going to go from current levels of about 117 up to that old high of 120. We can give ourselves, we don't need that much time. I don't want to go all the way out to the April monthlies. This trade should be able to last. This trade should take the next 2 to 3 weeks. So let's just go to those first weeklies in April. Those expire 23 days from now. They expire on the 7th of April. We're going to go ahead and buy the $117 call, pair that up with a sale of the 120, which becomes our upside technical objective, which becomes our short strike, which is the upper boundary of our trade. Altogether, guys, we're going to pay 91 cents, which is $91 per option spread we're trading. Looking at our P&L graph here, doesn't matter how low gold might fall. If we're wrong in this trade, max loss is $91 per option spread. Break even would be the long strike plus premium paid. So that's going to be up here right at about $117.90, depending on our fill. And our max profit will be up here where this purple line goes flat, which is our short strike up at around $120. Okay, so we have 91 cents of premium to pay. Let's put this trade to work. And we are now working. If 50% of that premium is eroded, we're left with about 45 cents. Let's go ahead and cut the trade. Obviously, our premise for being the trade is wrong, and let's simply move to this side, contain risk, and move on to the next trade idea. Otherwise, let's try to retest the highs in 120 in GLD. So that's the trade in the GLD, guys. Be sure to keep those stop losses in. We are looking for continued higher prices in the gold market on the back of a dovish Fed. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on that trade. Be sure to follow us at Trading Nation on Twitter for updates to this position, as well as all the other trades that our traders are working. See you guys in the next video update.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.